When trading any financial instrument, especially in day trading, understanding the relationship between different time frames is essential for making smart, well-timed decisions. Higher time frames reveal the bigger market picture, showing where the trend is headed, while lower time frames help pinpoint precise entries and exits. In this guide, we will explore how to use the daily and 4-hour charts effectively to identify trend direction, key levels, and quality trade setups using price action. This multi-time frame approach can greatly improve your trading accuracy and confidence. The daily chart shows price movement where each candlestick represents one full trading day. Generally, higher time frames like the daily and 4-hour charts offer more reliable signals and patterns because they smooth out noise and reflect stronger market consensus. This slower pace means that trends and key levels take time to form, but tend to provide a clearer picture of the market's overall direction. It is important to remember that traders usually do not execute trades solely based on the daily chart. Instead, the daily time frame serves as a strategic guide to identify important support and resistance levels, trend direction, and overall market bias, which then helps to time precise entries on lower time frames. For example, if the daily chart is in an uptrend, you should only look for buying opportunities. This aligns your trades with the dominant trend, increasing the probability of success. Entering against the daily trend, even on lower time frames, carries more risk and often leads to lower win rates. By following the direction of the daily trend, you stay on the side of momentum and make more informed, higher quality decisions. 3 powerful signs the bulls are in control before you even zoom in. If you are serious about trading with the trend, not against it, watch for these critical bullish clues on the daily chart before dropping down to lower time frames. 1. Resistance turns into rocket fuel. That major resistance level? It just flipped to support. Smart money is stepping in. 2. A breakthrough, not a fake out. Price smashed through a key daily resistance that had held strong multiple times. This is not random, it is a signal. 3. Bear trend crushed. The bearish structure is gone. We have a clear higher high, backed by a textbook trend reversal. Buyers are no longer hiding, they are charging in. Why this matters? These are not guesses. This is confirmed market behavior. When the daily chart screams bullish, your lower time frame setups become high probability trades. Pro tip, do not fight the market. Let momentum and volume show you the path. Follow the flow. Do not force it. Next, let us examine the 4-hour chart for more detailed insights. While the daily chart defines the bigger picture, major levels and overall trend, the 4-hour time frame zooms in to reveal price behavior and potential trade entries. Notice how key daily support and resistance levels remain clearly visible here. These zones act as strong magnets where price frequently reacts or reverses. Some high-probability trade setups on the 4-hour chart include 1. Entry signals at the confluence of daily levels and short-term 4-hour zones. 2. Confirmation through price structure, like a series of higher highs and higher lows in an uptrend. 3. Moving average crossovers near key levels, which reinforce the trend direction and boost confidence in your setup. 4. Sharp price reactions, like long wicks or consolidation zones, forming at these confluences, signaling market respect. By aligning multiple signals across time frames, the 4-hour chart becomes a powerful tool to fine-tune your entries and manage risk more effectively. Let's face it, drawing trend lines on higher time frames can be tricky. When the price action is tight and swings are shallow, those clean trend lines start to look more like suggestions than signals. This is where many traders get trapped, falling for false breakouts and jumping into weak setups. That is why pro traders don't stop at the daily chart. They zoom in. They break down the price action using the 4-hour, 1-hour, and even 15-minute charts to get laser-focused insights. These lower time frames expose the true microstructure behind every pullback, breakout, and shift in momentum. Here's where the 4-hour chart becomes a game changer. It bridges the gap between the big picture trend and the precise entry point. While the daily chart gives you the roadmap, the 4-hour chart puts a magnifying glass on the journey. Let's break down exactly what you can spot. Key signals to look for on the 4-hour: trend line breaks. Early signs of trend reversals become visible before they show up on the daily chart. 2. Higher highs and higher lows. These classic markers confirm a shift in market structure and momentum. 3. Failed pullbacks. When pullbacks stop making lower lows or form clean double bottoms, it signals the bears are losing steam. 4. Confluence zones. Watch how these signals often align near major daily and 4-hour levels, creating prime entry zones. 5. Run pullback run patterns. This repeated rhythm shows strength in the new trend direction, especially when volume supports the move. By combining these signals, you gain confidence, real confidence, not the hope-based kind. It is not just about seeing a trend, it is about confirming it from multiple angles before putting your capital on the line. Now, once you have that alignment, daily chart sets the direction, 4-hour confirms momentum, and the 1-hour or 15-minute nails the entry, you are looking at a high probability setup, not a guess. Why this multi-time frame strategy works across all markets. Whether you are trading Forex, crypto, stocks, or indices, this framework gives you the edge most traders overlook. The daily chart lays down the foundation, trend, key levels, big zones of support and resistance. The 4-hour chart adds depth, reveals the heartbeat of price action, and lower time frames give you sniper entry precision. This strategy keeps you calm, patient, and aligned with what the market is actually doing, not what you hope it will do. Discipline is the secret weapon here. Resist the urge to jump in too early. Wait for the alignment. Let the market show you when the tide is truly turning. When daily and 4-hour charts are in sync and price structure confirms the move, you are no longer reacting. You are strategically entering high-quality trades. Mastering multi-time frame analysis is what separates the consistent traders from the frustrated ones. It gives you precision, clarity, and the confidence to act only when the odds are stacked in your favor.